startup stock options, in theory, can make you a millionaire, or they can waste years of your life. How do you really tell the difference? What are the important questions to ask? And what do you need to understand to figure out if the options that you're considering are going to be worth something or are going to be worthless? Those are the questions I'm going to answer today in this video. So let's talk about the 4 different types of stock-related incentives. Now, we hear the term stock option used quite a lot as sort of an umbrella term related to some kind of financial compensation that an early employee at a software startup company typically gets. Think of the early employees of Facebook or Google, and they sort of become these millionaires over time, right? And stock option really is just one type of stock-related or equity-type incentive. And so let's talk about the 4 different types so you have a high level of familiarity with each, and then I'll give you a resource or link to a resource to figure out how to learn more in terms of the technical details. So the first type of stock-related incentive is known as the stock option. It's the one that's sort of most commonly used, particularly in early stage companies. Now, there are 2 types of stock options. One is known as a incentive stock option, or ISO, and the other is known as a non-qualified stock option, or an NSO, okay? We're in tech, we gotta have a lot of acronyms, and so you're gonna hear the term ISO and NSO sort of tossed around a lot, right? At a high level, these are geared towards people that contribute to helping the business become more successful. ISOs are better, they're more tax advantageous, but they can only be granted to employees. So if you're an employee and you're getting a stock option, you really want to try to get an ISO or work for a company that has ISOs. Now, NSOs, or non-qualified stock options, are given to people that don't qualify to be an employee, such as an outside advisor, a vendor, a contractor that does some early work for you. So those types of individuals get NSOs. Okay? So those are very similar, except they have very different tax treatment and restrictions around who is allowed to receive them. So that's the first type of a stock option. The second type of stock-related incentive program is known as a profit interest unit. Now, a PIU, now another acronym, we are in tech after all, a profit interest unit is similar to a stock option, except it's for an entity structure or a company that's been organized legally as a limited liability company, or LLC. You see, stock options are only allowed to be used with corporations, and C corporations specifically. An LLC, which is very common for smaller businesses in terms of when they first get organized and file legal papers to become a company, LLCs are not allowed to use stock options, so they have to use something, an alternative called a profit interest unit. Now, I actually like profit interest the most for a couple reasons, which we'll talk more about in a little bit. Number one, it's really tax efficient. That's good. So the receiver of the profit interest unit doesn't have to pay taxes in advance of getting some kind of profit from their equity holdings. And the other is you don't have to pay into the business to receive some kind of equity award. And we'll talk more about that in a second as well. So if you have a choice, my favorite to receive is a profit interest unit, or profit interest for short. But again, they're only allowed with LLCs and companies that have been formed as an LLC. The third type of equity or stock-related incentive is known as restricted stock. Now, as the name implies, you get stock in a company, you get ownership in a company, but guess what? It's restricted, right? As the name suggests. Sometimes we use clear communication in technology. Not always, but sometimes we do. Now, restricted stock is really used sort of at the 2 extremes of a company. There are 2 different types of restricted stock. One is called a restricted stock award, or RSA, and the other is a restricted stock unit, or RSU. There we go, with acronyms yet once again. Now, RSA, restricted stock awards, occur in brand new companies, right? And basically a restricted stock award is the employer gives you an award of stock, basically in the company. So it can be very popular for founders because they don't have to pay taxes on it. Now, a restricted stock unit is very different. It is granted and it vests, and meaning you can profit from it, only after you've been at the company a certain number of years, typically, and only after a certain milestone the company has been retrieved, such as a liquidity event, the company gets sold, or it goes public. Right? And so because of a whole variety of tax reasons we won't get into, just to often remember is restricted stock awards, brand new company when it has basically no value, and restricted stock units when it has value over $1 billion becomes very popular. So the 2 polar extremes is when you see restricted stock. Now, the final type of equity-like award is known as phantom stock. right? And phantom stock is not really giving you stock or ownership in the company. It is a private agreement between employer and employee that gives you cash compensation, like a bonus, like a year-end bonus, if you would, but only when the stock value of the company achieves certain milestones. So if the stock grows up, and doubles in value, then the company is going to pay you money based on a formula that it has determined, largely to mimic the value of the stock going up. So this is a way for employers to award employees and provide them incentives and financial benefits for doing things that make the shareholders wealthier. And they try to do a formula so the benefit sort of matches as if you had stock options in the company. This is probably less common in technology companies. You see it in other industries where the owners of the company really want to maintain a complete ownership of the stock, and they're not going to go do an M&A transaction. They're not going to do an IPO. These are sort of businesses that are sort of more everyday and not super innovative, not really tech-oriented. So you don't see them as often in technology companies, but you do hear that term used, and so I want to make sure you understand what that is. So phantom stock operates financially as if it were a stock option typically, but it doesn't actually grant you any ownership in this company itself. So it's just a financial incentive vehicle bonus program that's tied to making the stock price move in a particular direction that shareholders like. So those are the 4 key types of stock or equity related incentives. This topic is so deep. It is so deep. There are so many technical and tax related details that I'm not going to go into here, but I'm going to give you a link to a resource that I think is really good. And they've done an extremely detailed job in explaining all the nuances and differences between these different types of stock awards. And they include a lot of free calculators to figure out how much money you would make in certain situations, whether you're the employer or you're the employee. So the link is to Carta, carta.com/learn. Carta.com/learn. Now, I have no affiliation with Carta. Carta, if you're not familiar with it, is a software program used to keep track of all these different stock incentives and stock ownership programs for startup companies. So they're very, very popular in the startup tech world. And so thousands and thousands, maybe even tens of thousands of companies use Carta to manage who owns what stock class, who gets what kind of money and what kind of scenario, which gets very, very messy from a record keeping standpoint. So Carta is often a system of record for stock ownership in a company so they can keep track of it. And they've done a fabulous job in trying to explain all the technical details of how these different types of stock awards work. All right, now let's shift gears. Let's talk about the 5 key questions you have to ask and get answers to before you consider receiving any kind of stock-related incentive program. All right, number 1, all these programs have some level of quantity measure. Number of stock options, number of shares awarded, number of shares or units for LSCs that you are granted under certain conditions, right? So the first thing you want to understand is what kind of quantity are you getting of this instrument? And when you get a quantity number, like you get 10,000 shares or 10,000 units or options on 10,000 shares, that number by itself doesn't mean very much, right? Because it's just a number. I could give you 1 million stocks, units of shares in a company, but they could be worth 0, right? I could give you 1 share that's worth $1 billion. So the number of shares or units or options by itself doesn't tell you enough. So what you want to know is how many shares or how many units or how many ownership units exist in the entire pool and what percentage of the total do you have, right? And so when you were granted stock options, it's always granted in shares. It's never given to you in terms of percentage of ownership of the company because the number of shares could change over time, and it often does. So you get a number like 10,000 units, 10,000 shares, and what you want to ask is, well, how many total units of ownership or how many total shares are in existence right now? And then you figure out the percentage. And so when you look at a compensation award, you can just Google this. How many stock options is typical for a VP of finance to receive in an early stage company, right? And there's benchmarks out there for that. All those benchmarks are expressed in percentage of total ownership, not in terms of units or shares, okay? So you have to do a little bit of conversion on that in terms of the math. The second thing you want to ask is what is the stock price or ownership price after which you benefit? So for most stock options or stock option like awards, there is something known as a strike price, right? And the strike price is generally the value of the company on the day you join, right? So let's say you were an early employee in Google and you got stock options on the stock of Google at $10, right? That is your strike price. So if the Google sells in the public markets, does an IPO at $10, you don't get anything because you only get benefits when the stock is above your strike price or your threshold price. So most of these stock awards and equity-like awards have some kind of like threshold only above which you start to benefit financially, below which you do not. Okay. So most awards have something like that. So you want to know what that is. And generally speaking, it's what the board of directors or public markets, if it's a public company, feel the company is worth in terms of the stock price, what it's worth right now on the day you join. That's usually the form. So you want to be aware of that, and because it impacts whether you make money down the road. All right. The third thing you want to ask is, in order for you to receive these equity benefits, do you have to pay the company any money? Now, you might be a little confused by that because it's meant to be compensation for working really hard. But stock options don't give you stock in a company. They give you the right to buy stock in the company at a very cheap price. Okay? So let's say you're an early employee at Google and you have a stock option that gives you the right to buy a share of Google for $10, which is great. Google goes public, let's say, and now their stock price is worth, let's say, $100, right? That's great. That's good for you. Now, you don't get $100, right? You don't even get the $90 difference between the $10 threshold price and the $100 current market value. What you get in a stock option is the right to buy a share of Google at a certain price known as $10. Okay. So if you wanted to cash out your options, let's say they've vested, you've stayed long enough so that you actually are allowed to sell those. When you sell your stock options, you're not actually selling your stock options. What you're actually doing is you're writing a check to Google, your employer, for $10 for each share that you want of that option that you want to exercise. Now, with Google, when it's public, this is not a big deal because you pay $10 and then a minute later, you can sell that stock on the stock market and receive $100, right? And so you buy it for $10, you sell it for $100, and your profit is $90. That whole transaction is done basically within a few minutes, within a day or two, okay? That's very straightforward for a public company, right? However, private companies, you have to be very careful. You don't have a public stock market. You can't sell your shares. So this would be the equivalent of having stock options in Google when they were very young, before they were public. You have the right to buy stock at $10, but you can't sell it because nobody's out there to buy it, right? So when you have that opportunity to exercise those stock options, you have to pay Google cash. And there's often a deadline by which you have to make that decision right before a particular deadline. And so if you were an early employee at Google, for example, and you decided, hey, working at Google is not really my thing. I have these stock options for $10. Google's not public. Google's probably worth $30, maybe a couple months before its IPO. But for whatever reason, I'm going to move. I'm going to quit my job. Now, there's usually some kind of deadline by which you have to pay Google that $10 for their shares if you want them, or let it go, right? And this is the part where a lot of people don't really understand and appreciate. And in fact, if you look at data from Carta, which is that software company that manages all these stocks and shares and does all the math, and it's sort of the official record keeper of stocks for startup companies, they found in late 2024 that only 1/3 of the employees that receive stock options within the Carta customer family, only 1/3 of the employees that have profitable stock options actually exercised them and wrote a check to the company to buy shares in those companies. So 2/3 of the employees never exercised those stock options and just walked away from them with no financial benefit, right? So this is the part about stock options people don't really understand. It's something not talked about in the media, that with stock options at a certain point, you have a deadline, you got to pay in to get those shares. So it's really important you understand for the specific stock option award that you might be contemplating, perhaps in a job offer or in a promotion, you understand the implications of what decisions have to occur by when, and specifically, do you have to pay money to get value from that award? And if so, when do you have to pay that money? And when is your deadline by which you have to make that decision? Those are important factors to consider. The fourth question you want to ask and get answers to is related to taxes. When do you owe taxes? How much tax do you owe? And what type of tax is it? Now, there's a lot of money being made here, right? So the IRS wants its share and it's going to get it, right? The key is you have to understand, when do you owe a tax? What kind of tax is it? And what is the tax rate that's applied? Now, for all these different types of stock vehicles, the tax applications are very different. They're very, very different. And so that's why you want to go figure out the specifics for your stock award. Now, generally, there are three types of taxes that you could be paying. You're going to pay one of the three. You're either going to pay what's called capital gains tax, which is when you buy an asset like a stock and it goes up in value, and then you sell it, you pay a capital gains tax. There are short-term capital gains tax rates and there are long-term capital tax rates. Generally, capital gains is a lower tax rate than the last type of tax called ordinary income tax, the tax you file in your income taxes when you file every year. And so you want to know which one are you paying, because the rates are very different and that changes the financial benefit you receive in the end after taxes, and when you owe it. Super important. With certain types of stock awards, you pay taxes when you receive the award, not when you receive money from selling that stock. And so it's very important you understand the timing differences, because it has a very large implication and it could cost you quite a lot of money, right, to receive this stock award in the very end. So be very mindful of that and make sure you understand that and are comfortable with it. The fifth and final question you want to ask and get answers to is, what the heck happens if and when I leave the company? Now, stock incentive plans were designed to be golden handcuffs. They wanted really valuable employees to sort of be millionaires on paper, if you would. But if you quit, you lose all the money, right? And that was sort of the intention behind the invention of these programs. So what you want to understand is, if and when we leave the company for personal reasons, you just want to change careers or whatnot, what happens mathematically to those equity type incentives? What happens that day? What deadlines get triggered that start as of your exit date? And what decisions do you have to make after you make that decision to exit the company? So super important that you understand and get those questions answered. Last but not least, let's talk about the 4 ways you can figure out if your stock awards or stock options or stock-like incentives are going to be worth anything in the end. Now, again, stock options and stock awards, they could be worth millions. They could be worth nothing. You could have wasted 3 years of your career, right? There's a pretty wide range of outcomes. So in my experience working with startup companies of the last 30 years, here are the 4 big factors you really need to understand to kind of get some kind of assessment of whether those stock options are going to be worth anything in the end. All right, number 1, is your employer, is it a well-run, really good and successful business, right? Do you have customers? Are they happy? Is the business growing in terms of revenue? Is it well-run financially? Are the products good? Did you have a good reputation? So just the general principles of having a good business are foundational to having the stock and stock-like awards be valuable in the end, right? If you are not really a business person, maybe you have a technical background and you're trying to figure out, like, I don't know, how do I know this business is well-run? I'll refer you to one of my resources. This is a plug for my book. It's called Extreme Revenue Growth. And what it is, it's a guide for CEOs of technology startup companies on how to grow and run their businesses really successfully. Now, if you are not a founder, but you are working as an employee for a technical founder or a CEO of a technology company, it is useful for you to get some business background to objectively try to assess the business and successful prospects of the employer, your employer or prospective employer as a whole. Like, are they going to make it? Are they doing things right? Are the internal operations run in a way that's consistent with best practices for running a very successful business? So my book, Extreme Revenue Growth, explains all that. Again, more from the founder CEO perspective, but can be very useful for you to understand how to evaluate a business in general. Okay. So number 1, is a business successful? Is it well run? Is one of the 4 factors that determines whether your stock options are going to be worth anything. The second thing is around the liquidity of that stock. Now, when I say liquidity, that's sort of this big fancy Wall Street word, meaning, can you sell the darn thing, right? If you own stock in Google, in the early days before they were public, could you sell it? And the answer was largely no, right? Some exceptions are there for larger tech companies that have stayed private for a long time. But generally, stock in a company that's not public is really hard to sell. And so there's no benefit to you, at least not initially, to being a paper millionaire with stock that you cannot sell and therefore you cannot realize the profits. So liquidity, or the ability to sell the stock, becomes very, very important. So in that regards, a company that is public has an advantage because you can exercise your stock options and sell it the next day. Super easy to do. The downside with a big company is you usually don't get a lot of stock, right? Because they're already pretty successful. They know they're going to be around for a long time. So you typically see stock options and stock option-like awards granted to employees of very young companies that aren't very liquid. So what you want to know is, does the company have plans to become either public or to sell themselves to a larger company? In either of those two events where the company is being sold either to the public or to another company, those shares that you own or have rights to can then be sold to another party. There is a buyer with cash wanting to buy your shares, and therefore it can give you money, right? And so one of the things you want to think about is, what is their timeline to what's called a liquidity event? And again, liquidity event means an exchange of shares for cash, right? What is the timeline to a place in time where there's an active buyer willing to buy shares, and you as the employee are able to sell your shares or financial interests in the company? Okay? Some companies don't want to ever go public. They don't want to ever sell. And that's why they invented things like phantom stock options, because there is no planned liquidity event. There is no going public. They want to keep the business for many, many years and decades, if not centuries. And that's a way to sort of address and give those employees some kind of financial benefit. The third factor that determines whether your stock option is going to be worth anything is who owns the company. Typically, there are two categories of owners or shareholders. There's usually like the founders or the founding team, right? And then there are outside investors, typically venture capital firms, growth equity firms, private equity firms, or otherwise known as institutional capital, right? These are professional organizations that invest money professionally, often on behalf of insurance companies, private university endowment funds, and the like. Now, the reason that's important is because the behavior and the financial math formulas that determine whether your stock is worth something changes quite significantly, or has the potential to change quite significantly, when there are outside investors involved. Okay? Now, what I find is employees of tech companies, they have this sort of general impression of like, if the business does well, I should benefit and become wealthier, right? And when the company is entirely owned by founders, right, the people that started the company, that's typically true, like a good majority of the time. The better the business does, the more your stock is worth more and the more you benefit financially when the owners of the business are founders, right? When there are professional investors involved, especially institutional capital or institutional investors, that math changes. It is entirely possible. It is entirely possible for the business to be very, very successful in the long run and for you to get nothing from it, right? And so that's a very important distinction. And so you want to know who else is owning the company. Is it all members of the founding team, or are there professional investors involved? Now, a lot of the most wildly profitable, successful startup companies in the world have had professional investors involved. And the early employees benefited tremendously financially from that. But there are a certain set of situations where having professional investors involved really devalues the amount of the value of your holdings as an employee and stock option holder. So when the owners of the company and the shareholders of the company are institutional and professional investors, right, this introduces another variable that determines whether or not your stock options are going to be worth something down the road. This leads us to the fourth and most important factor that determines whether your stock options are going to be worth anything. And it has to do with the specific terms of the investor's agreement with the company when they made the investment. Now, the problem with that is that fine print makes an enormous difference, night and day difference, on whether your stock options are going to be worth something or not. The problem for you as an employee is those agreements are confidential. They won't share them with you. Like very, very few people, it's the finance team, the legal team, and the CEO really are the ones that know the specific details, right, of those agreements. So, but there are some behaviors and sort of actions that companies take that are indicative of those agreements and are related to whether you're going to make money from these stock options or not. And there are also other telltale signs that I want you to be aware of that tend to indicate your stock options are worth less and less with every passing moment. And so it's a bit technical, so bear with me, but this is a very important concept for you to understand that very few people grasp and understand appropriately. All right. Now, you have to understand this, you have to understand how institutional professional investors think, right? Their job is to make money for their investors, right? Yes, your investors as a company also have investors, right? So these institutional investors, they represent people like the endowment funds for Ivy League universities, insurance companies, wealthy individuals, and so forth. So they owe it, and their whole charter is to make their investors more money, right? And so the scenario under which everyone wins, the investors win, the investors' investors win, the founders win and employees win is under a very specific set of circumstances. And so let me explain what they are. It's when the value of the company at every round of investment or financing goes up and never comes down. And so this was true with Google, right? Early investors bought shares for maybe $1. Then they did some additional investment. Maybe it was worth $10. And then they went public and the shares were worth $100. But at every round of financing, the value of the company or the stock price never went down. It was always the same or higher. Under that specific set of circumstances, founding teams do well financially and employees do well financially, okay? And this is by design, right? These investors, these professional investors want the company to become more and more valuable. That's why they invested. They don't want their holdings to become less valuable. And so they put in effect, a lot of draconian penalties if the company's value goes down between rounds of investing and financing, okay? That's super important. Let me repeat that, because this is the part where people don't understand. And this is where companies like venture capitalists get called vulture capitalists, right? Because of these specific draconian terms. But they're not trying to hide anything. It's just these founders and employees just don't understand this. They're sort of ignoring it. But you have to, I beg you, understand this. It is the difference between a millionaire and being broke, right? From stock options. These investor agreements have a massive financial penalty to shareholders, specifically founding team members and employees, if the value of the investment goes down between financing rounds, okay? And there's a term for this in the professional investor community called a down round. And down round means that in a round of new investment, the value of the company has gone down in value, okay? They do not like that. And I tell you, they will make you pay for it, right? And the opposite of a down round is an up round. So between one round of investing and the next, the value of the company has gone up. Everyone's happy. Everyone likes that a lot, okay? So in an up round, in a series of up round situations, employees like you do well. When there's down rounds, what ends up happening, to sort of oversimplify a little bit, is these investors have written clauses, these fine print clauses in their agreements, that if there is a down round, that the founding team members that hold stock in the company and the employees will make that investor whole by essentially giving them shares, or basically making up for it. And the mechanism is less important, but in essence, giving financial value from founding team members and employees, transferring that wealth to the professional investor to make them whole and compensate them for the loss they incurred from a down round. That is 90% of where you see sort of this vulture capitalist stuff occur, and that sort of terminology, when professional investors seem like they screw over the entrepreneur. That's really where it is. It's in the down round. And what most people don't realize is your equity as an employee is essentially transferred in wealth to the professional investor when there's a down round. 99% of employees don't know this. 90% of entrepreneurs don't know this either, right? So when I work with companies, startup companies, I always advise using legal counsel that has done at least 100 M&A, venture capital, growth equity type of financial transactions. Super important. They can explain the ins and outs to you. Then you got to listen to your very, very good attorney, okay? Super, super important. And you want someone that has done at least 100 transactions. Super important. So now, how do you prevent a down round, right? Here's what happens. You never want a down round as a founding team member or as a founder, but sometimes you have no choice, right? So down rounds, if you can avoid them as a founder, you absolutely want to avoid them. If you're an employee, you absolutely want the CEO and founder of your company to avoid a down round. It's bad news for everyone. You're all going to lose a lot of money in that situation. Bad, bad news, okay? Now, why would a founder of a company ever do a down round, right? I'll give you one simple answer. They have no choice, okay? So there are down rounds, and then there are what I call forced rounds of investing. And a forced round of investing is when you are about to run out of money, and having a down round is better than going bankrupt, right? Because the only thing worse than a down round is going bankrupt, right? Because then your shares are worth nothing. However, what's a bit of a hidden situation is sometimes it's actually better to go bankrupt for the employee, because at least when you're bankrupt, you know your stock is worthless, right? And then you can go get a job somewhere else. When there's a down round, right, you don't know how much your stock is worth. You don't get access to that kind of information. And so you can still work there for 3, 4, 5, 10 more years. And I have one person I know that had stock options in a very successful company, or seemingly successful, and they held it for 20 years, right? This is a company with 80 million a year in sales. And it was worth nothing because there were down rounds in the middle, right? And it wiped out employees and the founding team in terms of stock holdings. So super important to avoid a down round by avoiding a forced round when you have no choice but to raise capital at very disadvantageous terms. Okay. So key, avoid the forced round is how you avoid the down round. Now the question is, how do you avoid a forced round of financing where you are forced to raise capital under very bad terms? Right? The key here is you run out of money, right? You run out of money. And when you run out of money, your options go down dramatically, right? So a key milestone to look out for that executive team leaders, CEOs are probably more likely to share within employees is whether or not the company is profitable or cash flow positive. So profitable means whatever your expenses are, the money you make is higher. Cash flow positive is the same idea, except it takes away things like delays for collecting payments from customers and whatnot. It just looks at the bank account. So when there's more cash coming into the bank account than going out every month, you are now in a situation known as cash flow positive. Cash flow positive is very, very good, right? When you have enough cash in the bank and the cash balance in the bank account and the company bank account is going up, it's impossible to go out of business, right? Super, super important. So when you are an early stage company, a question you want to ask is, are you cash flow positive? And if not, when do you expect to be, right? And you want to measure and monitor that achievement of milestone, because the second you are cash flow positive, you never have to do a forced round of financing, okay? And if you never have to do a forced round of financing, you can consistently and reliably avoid a down round of financing where all those draconian terms, right, come into effect to make the professional investors from earlier rounds whole, often at your expense. So cash flow positive, very, very important, okay? So to recap, be cash flow positive, have positive, more cash coming to the bank account than not. That helps you avoid the forced round of financing, which then helps you avoid the down round of financing where you get screwed. Super important. Now, how do you know if they're going to be cash flow positive? One question to ask is with the executive team, is there a CFO? Okay. Or is the founder very savvy and knowledgeable about finances, right? So you want someone on that executive team that really is watching the financial numbers and is making wise financial management decisions. The stronger the financial team, the more likely they're paying attention to the stuff than not. Okay? So that's kind of what you're looking for. Now, there are a few exceptions to this rule. Of course, there are a few exceptions. We're going to talk about that, right? And it has to do with the type of investor that is involved in a company. Okay? There are 3 types of professional investors, right? Actually, there's 4 types of investors, 3 of which I would consider professional or institutional. There's angel investors, which is like people that you know personally, or their founder knows personally that throws in money. They're not active managers. They're not on the board, right? They're just sort of doing a favor because they believe in the person starting the company. I'm often called friends and family. I'm not going to count those folks. It's after that round of initial money where professionals get involved. There are 3 kinds of professional or institutional investors, and they have very different approaches to investing. There's venture capital, right, which is a term you hear a lot, but actually people often misunderstand what that means. There's something called growth equity investors and something called private equity investors, okay? And those 3 categories of investors typically match the stage of the company. So venture capital firms usually are geared towards smaller companies, not always. Growth investors are usually companies that tend to be invested companies that can be cash flow positive. And private equity firms also tend to invest in companies that have the ability to be cash flow positive. Now, here are the big differences between these 3 different types of investors. And by the way, people will tell you who's investing in the company. That's pretty common knowledge amongst employees, and executive team leaders and CEOs are happy to share that because it often lends credibility to the business. Then you want to go figure out who the investors are, then Google, they will go to their websites and figure out what kind of investor are they? Are they a venture capital investor, a growth equity investor, or a private equity investor. Because those three companies have very different financial approaches to how they manage and how they want the management team to manage finances. Okay. Super, super, super important. And most will misunderstand this, including CEOs of companies 10, 20, 30 million a year in sales. Let me explain what the differences are. Venture capital investors have a particular profile of risk that they like. They are high risk, high reward investors, right? These are the people that invest in Google and ChatGPT, right? Or OpenAI. These are the companies that want to make billions of dollars, or they want your company to be bankrupt, right? All institutional capital investors really want to have a big win, right? They want to make more money. That's not surprising. But how they do it varies a lot. And what makes venture capitalist investors different from the other types of investors is their willingness to lose all of their money in order to get a winner, right? So a venture capital investor, if they make 10 investments, they're happy having 9 of those investments be completely worthless and have those companies go bankrupt and lay off all employees. They don't care. So long as that 1 out of 10 becomes like the next Google, next Uber, something along those lines. So they're looking for like the multi-billion-dollar win, right? And they're willing to have you get laid off in order for them to get a shot at that $1 billion. Okay. And what that specifically means in terms of how they want the companies they invest in to manage their finances, they want growth at all costs. And they want the CFOs and the CEOs of perhaps your company that you're considering working for, they want those teams to spend a lot of money, lose a lot of money really, really fast, so long as there's very fast growth in terms of market share. Not even sales, but market share, right? So think about Facebook early on for the first few years. Facebook made no money, but wow, it was growing so fast. Look at Instagram. It was growing so fast in its early days in that first 18 months, right? And these investors were willing to invest in something with very, very high market share growth, right? Even though it wasn't super profitable. Now, this has a couple implications, and this is where the rubber meets the road. When you are intentionally burning cash and losing a lot of money, you have what's called negative cash flow, right? There's more cash coming out of the company bank account than is going into the company bank account. You are negative, right? And what that means is you have a date after which you will be bankrupt as a company, right? And so this is where companies get into a forced round situation. When you have negative cash flow, you can mathematically calculate when you will be bankrupt. If you have $1 million of cash in the bank and every month, right, $100,000 is going out of the checking account that more than is coming in, so the net cash flow is negative by $100,000 a month, then you know mathematically in 10 months, you'll be out of cash and basically you'll be bankrupt, okay? And so you hear terms like cash burn, the burn rate. Those are such terms that you hear in companies that are lighting $100 bills on fire and they are burning cash intentionally in order to get a shot at massive growth and become the next. So the risk reward profile is extremely binary. They want to be billionaires or bankrupt, right? BB, billionaire or bankrupt. That's what the venture capitalist wants. The problem with that is if it's a home run business and it works like an Uber, that's fine. But you are on a forced death march to bankruptcy in 10 months, 18 months, 22 months, where you will be bankrupt unless you get cash flow positive in that time or you raise another round of financing. Okay? So you are basically driving the car off the cliff, right? Hoping you can build wings so you become an airplane before you get off the cliff, right? Or someone else, an investor comes in and makes the road longer before you get to the next cliff, right? And so this is where forced rounds come into play. When you hit that 9-month mark and you're about to run out of cash and going to go bankrupt, you are forced to do a round if you have not become cash flow positive and profitable at that point. Now, if you are doing a forced round and things are going really well, then it could be a forced round that's an up round, and that would be okay. But stuff happens in the world. COVID happens, stock market crashes happen. All kinds of random things can happen in the world that make market conditions more difficult and that make it so that progress in the marketplace isn't achieved like it was expected. And so when the financial performance and the market performance of a business isn't super high, right, and gets sort of stalled out, and you're forced to do a forced round when your performance isn't that great, then what comes in is the death knell for employee stock option holders, which is the down round. right? You do not want to be in a down round because you as an employee will make the early investors whole. That's where vulture capitalists get their name. Not entirely their fault. It's just people need to understand and be educated about what they are agreeing to, right? And that forced death march is a big problem. So that's what happens with a venture capitalist institutional investor. There are other firms that have very similar sounding names as venture capitalists, but have a very different financial strategy. Super important to recognize the difference. The next level up in terms of type of investor would be called a growth equity investor. A growth equity investor. Now, growth equity investors do not like their companies that they invest in to go bankrupt. They think that's a bad situation, right? What they want to do is they want to invest in companies that are very well run, customers are happy, sales are growing, things like that, that has a financial performance such that they're either profitable, cash flow positive, or they could very easily be within 90 days if they wanted to, right? So they have the option to be cash flow positive at any moment in time, but they want to be more aggressive in growth. And so this growth equity investor will put capital into the investment into the company. The company will maybe hire employees earlier than they otherwise would, which might include you, right? And the idea is we want to sustain this growth rate. So we're going to try to get employees on earlier so they can get trained and onboarded and be productive sooner rather than doing things in a more measured way, okay? But at every point in time, the growth equity investor wants the financial management team to manage their finances such that if there was something weird in the economy, another COVID, that the company could be profitable within 90 days by not hiring new people, maybe doing a very small minor layoff of just a lot of people they hired in the last 90 days, something along those lines, right? And that they will never be in a cash flow negative position involuntarily, right? And so the growth equity investor does not want to do a down round. And so that is their financial approach. They want a more conservative financial approach that is top line or growth oriented without taking on risk of bankruptcy. So venture capitalists, they want you to be bankrupt so long as they get their shot at the billions of dollars, right? Growth equity investors do not want you to be bankrupt, right? They want you to grow prudently with their capital, but not take massive bet the company risks, okay? So I like the companies I work with, I like them to take capital from the growth equity investors because it's just an appropriate situation for most companies. If you invented the next AI, if you invented the first search engine like Google, different, venture capital can make sense. But if most businesses I work with, which are B2B, SaaS-oriented businesses that sell to other companies and sort of specialized markets, growth equity often is a very good type of partner because the alignment of their financial approach typically mirrors that of many founders. Okay? The last and final type of investor is known as a private equity investor. And they like to invest in businesses that are cash flow positive. And a growth equity investor, they're going to write a large check, maybe a $10 million check, and they're going to transfer that check and put it in your employer's company bank account, right? A private equity investor is a little bit different. They will oftentimes write a check to the company so the company can deposit in the company checking account. But they're more interested in buying shares from the founders and potentially employees as well. So they're willing to write a large check, $20, $30, $40, $50 million, $100 million, where the check gets deposited in the founder's checking account and the checking account for the employees that are willing to sell their shares in that transaction, right? So that's the big difference. Growth equity investors don't want money going to employees and to shareholders, the founding shareholders. They want all the money to go into the company checking account to grow the business faster. Private equity firms are willing to pay you employees and you, the founding members of the founding team, a check to buy out your shares, right? So that's the big difference between a venture capital investor that wants to go bankrupt or billionaire, right? Growth equity investor that wants to make hundreds of millions of dollars, but they don't want you to go bankrupt, but they want all their investment to go into growing the business versus private equity investors, which are willing to privately buy your stock holdings from you as well as from the founders of the company. And on occasion, they're also willing to put some money into the company checking account in order to grow the business. So it's very important when you evaluate a company that you're considering to work for, who are the investors? Google them, go read their websites. They'll tell you what kind of investor they are. And are they a venture capital investor? Are they a growth equity investor? Or are they a private equity investor? Because that will dictate and imply a certain financial cash management approach. And that will either increase the risk of a down round or really significantly minimize that. And that has a positive or negative impact on the value of your stock option holdings and whether they're going to be worth something someday. Whew, that was a big topic. I hope you found this video on stock options useful. If you have, please like the video, subscribe to my YouTube channel for more content related to SaaS startup businesses. And if you have any questions, ask them in the comments. I'm happy to answer any questions you might have. And until then, be super careful. Do your homework on stock options. Know what you're getting yourself into. It's a very thin line between being a millionaire versus wasting years of your career. Hope this has been helpful and have a great day.